Good day, fellow investors. There were some comments asking me about an update on Campari, and if you like your Aperol Spritz or things like that, why not discuss a stock that I discussed a few years ago? Of course, in the video I said that it was too risky, too exuberant, that the company need to grow 2x in the next 7 years, another 2x to justify this high PE ratio. Let's look a little bit at the results and discuss the risk and reward as the stock now is significantly down. I have adjusted the P ratio, and the P ratio is not 30, it is now 23, much lower. As you can see, the stock crashed, and the question is now whether this small cap relatively is a buy. I've looked a little bit at the numbers here, and there is a decline in sales, but there is high competition and the market there is weakening a little bit, but they are still doing okay. They still have strong brands, they still make money, so nothing wrong with that. One problem I have with this is competition. Everyone is trying to enter the market, but if you look at things, they are still okay with their revenues, stable, nothing wrong there. Operating income, stable, so they still make some money there, and they have some merger and restructuring charges, so if I eliminate that, then I go to about 300 million of net income to the company. 300 million, the P ratio is 23. Much better than the 37 that there was, but when it comes to P ratios, we have also then to look at the substance of that P ratio, how it is created, and whether it is a real creation of value for you as investor or not. And this is something that creates a problem for me with these companies. So they do, and they go and buy Courvoisier, paying well over market value because they are such geniuses. Well, when you are at a party, you drink a few Aperol Spritz, things like that, colored water, and then you decide to spend $1 billion here and there. The thing is that this acquisition, they need to make these acquisitions to grow and to keep their market share, but at the same time they are increasing debt. If you look at total liabilities are going higher. They have increased stock numbers that they have diluted you also to buy that thing, which means that the issuance of common stock there destroys value over time, and then they pay over market value, and that is a big issue with these things, because then yes, they have accounting profits, but if you need constantly to acquire other things to make your accounting profits look good, that is not real profits, that is not cash going into investor pockets, which means there will be impairments and things like that, and therefore the risk there is high. It might be interesting at a P ratio of 23, but the reality is you need at a P ratio of 12 to make it interesting, thus another 50% down. It might happen, it might not happen. You say it's a great company, great brands, it is profitable, but the profitability there is not real profitability. And we also discussed Nike, where the profitability is real, but that too can go from a P ratio of 40 of a great business, can crash 50%, and the stock can do things even worse. So I prefer to avoid these kind of companies. Nike is a better company than Campari because the profits are real there, but it's still expensive to me. When Nike will be at a P ratio of 12, then we can also look at that. Just a quick video to just give you some food for thought. Check my research platform for value investments, where I look for real earnings, real profits, real shareholder rewards with a margin of safety, which is something that Campari doesn't have. For such a strategy with my portfolios, with coverage on stocks, check my research platform.